Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda. A margin loan is a type of loan that allows an investor to borrow money to invest in securities such as stocks, bonds, or mutual funds. The loan is secured by the assets in the investor's investment portfolio. Here's how a margin loan works. Let's say you have $50,000 in a brokerage account and you want to buy $75,000 worth of stocks. You could use a margin loan to borrow the additional $25,000 from your broker to purchase the stocks. The $50,000 in your brokerage account serves as collateral for the loan. In order to qualify for a margin loan, you'll need to have a margin account with your broker. The broker will set a minimum equity level that you must maintain in your account, which is typically around 30% of the total value of your portfolio. This means that if the value of your portfolio drops below the minimum equity level, you'll be required to deposit additional funds to bring it back up to the required level. This is known as a margin call. One of the advantages of a margin loan is that it can provide additional buying power for investors who want to increase their exposure to the stock market. It can also be a way to access cash without having to sell investments, which can trigger capital gains taxes. However, margin loans also come with significant risks. Because the loan is secured by the investor's assets, a drop in the value of the portfolio can result in a margin call, requiring the investor to deposit additional funds to cover the loan. If the investor is unable to meet the margin call, the broker can sell securities from the portfolio to cover the loan, which could result in significant losses. Additionally, borrowing money to invest in the stock market increases the investor's exposure to market volatility. If the market experiences a downturn, the investor could experience losses not only on their investment, but also on the margin loan. Margin loans can also be subject to interest charges, which can add to the overall cost of the investment. Interest rates on margin loans can vary depending on the broker and the investor's creditworthiness. In summary, a margin loan is a type of loan that allows investors to borrow money to invest in securities. The loan is secured by the assets in the investor's portfolio, and interest is charged on the loan. While margin loans can provide additional buying power and access to cash, they also come with significant risks, including the potential for margin calls and losses due to market volatility. As with any investment strategy, it's important to carefully consider the risks and benefits before using a margin loan. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay in explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.